when people will demand higher interest rates for debt, like they just won't agree to a low interest rate, the Fed's hands get tied. That's when things get really interesting, Elijah.
This week's specials with Miles Franklin Precious Metal Investments. 1 ounce 2021 Silver Britannias for only $3.75 over spot. And 1 ounce 2021 Silver Krugerrands for only $3.95 over spot. Call us at 1-888-81-LIBERTY. That's 1-888-815-4237. Hey everyone, this is Elijah K. Johnson with Liberty in Finance. And back with us today is Lobo Tiggre from the Independent Speculator. Lobo, thank you so much for joining us today.
I'm happy to be back on the show, Elijah.
Definitely. Now, we got a really positive response from our last interview with you. A lot of people were interested in how, something had changed, you said, in the gold market. Now, what you outlined was that gold is normally negatively correlated with real interest rates. So that's inflation-adjusted interest rates. At that point, it was more negatively correlated with the dollar index instead. Now, I'd like to get an update on that. Is that still what we're seeing, and what is the significance of this?
Well, the short answer is yes. In fact, as you and I speak, I don't know when this will be posted, but as you and I speak here Tuesday morning, the U.S. 10-year benchmark rate is down, gold is down, dollar via the DXY is up. So that changed relationship is still in force. An interesting sort of sideways update on this, triangulate, because I'm not always right about everything, is I talked to Rick Rule about this recently. I went to his retirement party out in California before kicking rocks on projects in Western states. And I asked him about that, and he really didn't ascribe as much significance to it as I did. He sees it. He sees the data and the charts just as I have, but it's short term. And he reminds me, and all of us, that, okay, the daily wiggles might be doing this odd thing, but the main picture here is that we are in a time of profoundly negative real interest rates. And gold is staying around 1,800, a historically high, at least nominal price. So it's not correct to say that the relationship is broken or that real rates don't matter anymore. I would agree with Rick, and if I ever suggested that, then I retract that or apologize. I didn't mean that rates don't matter. I just meant that if you look at these things, particularly on the daily basis, it is striking how often traders are making a decision based on what the dollar is doing in foreign exchange rather than what interest rates are doing. And that is still different. It's still happening now. It's not one-to-one. Some days it seems to go away. Other days it comes back. But that's a pattern this year, and it's still strong. What does it mean? What does it tell me? Same as last time. To me, it tells me that people don't trust the inflation data. People don't trust the interest rate data. They don't know to what degree the impact of the Fed's activities are affecting rates. If they started intervening on the long end of the curve, would they tell us in advance? Would it just sort of happen and we'd find out? Or, is their bond purchasing having a greater effect on rates than it might otherwise do? They don't have to actually intervene directly in the yield curve with this quantitative easing also having an impact. So it's complicated, and I don't pretend to know all of this. I'm not a Harvard economist groomed for the Fed, but it is different. It is significant. And while the big takeaway from this is, while it seems like the dollar is strong, or the story is that the U.S. economy is surging, that potential dollar strength puts a cap on gold. And people are saying, well, there's high inflation. Why isn't gold doing better? Well, this is, I think, a big part of the answer, is that the dollar seems to be doing better, which is crazy, right? You've got high inflation. That's, by definition, bad for the dollar. But the global perception is, the U.S. economy is doing great. We want dollars, we need dollars to participate in it. Or we're more worried about our economy, so we're going to go into dollars. And that, until rates reassert themselves as the prime driver, that dollar strength or apparent strength in foreign exchange is a headwind for gold. And I think an opportunity, a source thereof.
I think that's such a good point. And you mentioned people are not trusting the inflation rate. And this is something that we've been hearing a lot about, that inflation is going to be transitory. And some people are actually arguing that there's going to be deflation in the future. And you've written a lot about this recently, and you're not buying that argument. So did you want to first lay out for our viewers what you call actually a strong argument for deflation and why you don't buy it?
I'll do that, but let me say there's kind of two arguments for deflation. There's a sort of mainstream argument for deflation, which is just that, as we come over the post-COVID surge, economy settles down, the enduring negative effects of the pandemic will cause some weakness, and that's deflationary. There's a sort of more gold bug friendly version of the argument, though, that some of the economists, fiscal conservatives and observers, analysts that we respect and love are articulating, and that's harder core. It's more like, no, there's going to be a crash, or things are really much worse than they look. Things are much more fragile. And there's a potential here for a serious economic downturn, and not just muddling along, not just, coming off the high, but actually, a big downturn. And that would be deflationary. In a market crash or in an economic major downturn, whether the severe recession turns into a depression or not, a severe recession is going to have more people unemployed, less spending, and that's deflationary. So in either case, I don't buy it, because first and foremost, I think the printing press can run faster than anything else. There is a limit to how much people cannot spend or tighten their belts. They still have to eat. And if they can't eat, the government will give them money to eat. At some point, you can't have people just dropping dead all over the place. Not in modern society. We don't allow that anymore. So there will be a government response. And I do think that it's possible, it's certainly near term, that sort of more catastrophic version of the deflation argument. Sure, there's a big market crash, economy goes into reverse in a big way, you can see some deflation. I mean, in fact, in March of last year, when the real COVID panic and shutdowns hit, their CPI went negative. Now, it was just a flash in the pan. It didn't last. That was transitory. So I don't think changes the big picture. But yes, in an acute situation like that, you can see some deflation. But you know what? That set the stage for a huge gold rebound. Everybody could see what it meant. So this sort of catastrophic argument for deflation, I think, is transitory. That if it happens, creates a buying opportunity. And by the way, that potential is one reason why I'm not all in. I have been buying this year. I've been putting my money where my mouth is. I don't know that there's going to be a big crash or recession. And I think gold and silver are going higher. I think all commodities are going higher. So I've been putting my money where my mouth is on that, but I've been holding cash back for this scenario in case the fiscal conservatives who are calling for deflation are correct. The other guys, I don't think it's going to happen. If there's no big recession, crash, or anything like that, I think the money printing already done ensures higher prices. And we see it now. The U.S. is supposedly cooling, and yet the inflation numbers are still high. And you look at the commodities prices, copper rebounding, staying above, $4 for not just a spike, but now staying above $4. And a lot of other commodities high. They're talking about oil retreating, but it's still around $70. That's a lot. So no, I don't see the mainstream deflation argument at all.
Now, I guess, can you explain a little bit more for our viewers the difference between this mainstream deflationary argument and the one that you actually see is a possibility?
It's crash or no crash would be the simple way to put it. The mainstream argument is more like just the economy is weak and it will take longer to recover. Or that the Fed will see inflation running hot and will clamp down and raise rates, and that will slow the economy. And that, that the Fed can actually control inflation is a way of putting it, right? That the Fed will intervene and that will be deflationary. Now, everybody should know, if they don't, they should understand that the Fed doesn't have a button, right? There's no dial deep down in the basement in some vault guarded by, 27 Marines where you have this button you push and turn the dial, inflation at this number. From Bernanke onwards, they'll say, oh, yes, we control inflation. I can set inflation tomorrow in 15 minutes. It's not real. What they do is they intervene in the market. The market still exists, and they buy and sell, and they try to push the price where they want it. But there are times where the market just says no. What if there's a seller and there's no buyer, or the other way around? So the Fed actually does not control interest rates. It intervenes in the interest rate market, and there are limits to that intervention. And when people will demand higher interest rates for debt, like they just won't agree to a low interest rates, the Fed's hands get tied. So I think that's when things get really interesting, Elijah.
Definitely. And I mean, with regard to monetary and fiscal policy, and you're talking about the Fed setting interest rates, they can't really do that. They have different ways of influencing it, but they can't just set it automatically.
The so-called tools. The so-called tools. We have the tools, right? Sorry, but let me jump in again, just say, because Powell seems like a nice guy. Maybe he has no choice but to say what he says. But he keeps saying, we got the tools, we got the tools. No worries, don't worry about inflation. But the tool, the primary tool to fight inflation is the Volcker tool, to raise rates. But they can't do that if the economy is weak. The whole model presumes that high inflation means booming economy. You have a strong economy generating this high inflation. Therefore, you can afford to tamp down rates and slow that hot economy. But what if you have high inflation and, a subpar economy? And you're going to raise rates and make that subpar go down even lower? That's poison rather than medicine, not a cure. So they keep saying, we got the tools. But they must know that tool doesn't work unless we have, a true recovery, which we don't.
So this idea about kind of stagflation or a slowing economy and high inflation, the Fed is not prepared for that. Is that what you're saying?
Yes. They don't seem to even admit that that's a possibility. And it's interesting because it's not just Nouriel Roubini and some of these perma bears out there and that Lobo Tiggre guy talking about, stagflation, which I have been doing. It's getting a lot of ink in mainstream press. You see it on the Wall Street Journal, CNBC, you see it all over the place. And the Fed's just ignoring it. Like, that's not in the model. It's a sort of neo-Keynesian model. I don't exactly know why these people can just pretend that the 1970s didn't happen. They just kind of say, well, it's been decades and decades. We don't have to worry about inflation. Like, it's a new world. And that, therefore what happened in the 70s doesn't matter. But you know what? It does matter. History shows, human nature hasn't changed. Economics isn't about the little pieces of paper or the electronic ghosts of those pieces of paper, moving around. It's about human action. It's about human decision making. And human nature hasn't changed. So the 70s do show that it is possible to have high inflation without high economic growth. And, their tools don't work in that scenario. And that's something they should be worried about. Maybe they even are, Elijah, but just since they don't have anything else to say, they don't say anything at all.
Now, the cause of the inflation that we're seeing right now, a lot of people point to how we saw all the stimulus and the money creation by the Fed, and your perspective then on that, as we're seeing, that was in response to the pandemic, but now we're seeing in some areas the pandemic getting worse. At least that's what the mainstream is saying. And that's what, if we're seeing, lockdowns in certain areas and stuff like that. So if we do see this push towards further lockdowns and then the need for further stimulus, how will that impact inflation?
Well, economists don't agree on this, Elijah. And I'm not a professional economist, so take what I say with a grain of salt. And by the way, my Austrian friends get upset with me. My hardcore Austrian economics friends get upset with me when I talk too much about velocity of money, because that's not a hardcore Austrian thing. And Mises criticized it, if I remember correctly. And the GDP number itself. But in a fractional reserve banking system, in a system that fiat money has no intrinsic value whatsoever, things like confidence do matter. Shouldn't matter in a real economy, but they do matter because, the fiat money system rests on confidence, not fundamental value. There's nothing there. It's just people's confidence that people will take their dollars tomorrow. And on top of that, you get the fractional reserve banking system, or you can, relend. And so confidence and expectations do matter because they can increase and reduce the velocity of money, how many times those same dollars go through the economy. And so you can print a lot of money and have decreasing velocity of money, whatever that is, cancel each other out. And this is, I think, important particularly for gold and silver bugs to keep in mind. And I use that term lovingly. I call myself a gold and silver bug. It's not an insult. To keep this in mind, because there's this criticism of, oh, look, we printed all kinds of money after 2008 and there was no inflation. Well, there was some, but not as much as everybody thought. The monetarists would have thought, print all this money, there should be more inflation. Well, this is why. You had counterbalancing effects. So when you say, what will more money printing do? I'd like to say, well, gee, that's going to result in more inflation. And ultimately it will, but it may not if, there's more lockdowns, more shutdowns, and there's decelerating factors at the same time. What I will say, though, is, don't give up. Doesn't mean that money printing doesn't matter. It means that there can be temporary masking of monetary policy and its impact. And when the mask comes off, things happen. And people might say, well, why hasn't the mask come off yet? 2008 was a long time ago, and now here we go again. Well, it has. We've got sustained $1,800 gold, $25 silver. Those are nominally, at least, historically high prices. And by the way, prices at which miners can make a lot of money. It's an important thing to keep in mind. As a gold investor, as a gold bug, I want gold prices to go up. But as a speculator in these stocks, gold doesn't need to go anywhere. The better companies and the better projects make tons of money at current levels. So inflation, yes, I do expect there to be more inflationary pressure as a result of the lockdowns and or the money printing that's coming. And don't forget, we have fiscal policy anyway. The Republicans and Democrats have agreed on the first trillion or so. That infrastructure bill is coming. There's more easy money flooding out of Washington with or without lockdowns. I do think that's inflationary, but don't expect it to go right away. We're dealing not in a world of like hard mechanical relationships like gears anymore. It's this politically correct world of rubber bands and gum that just kind of stretches and wobbles around. But even with bubble gum and rubber bands, mass matters, and mass, when it gets moving, has momentum. And so that's my analogy for the money printing. It matters, it's massive, it has momentum, it will impact the prices, or the price of gold and silver is one way to say it. I like to say the gold-dollar exchange ratio, because gold is money and so is silver.
Now, one of the things that I would like to touch on is kind of the importance of due diligence. And you recently actually mentioning, the profitability of mining companies right now. You took a trip out west, and it's really important to learn about those mining companies and to see, the geology and all of that. So kind of if you could share with the viewers kind of what you learned from your trip out west just recently.
Sure. Well, I got to say, I have a paid service called My Take, in which I give my take on companies. So it's not fair to paying customers for me to give away all my research. But I have shared some general observations in my free educational digest, which I'm willing to give to everybody. And it matters. It's not just cheap stuff. I think this is important. First and foremost, business is booming in the mining sector out west. It is hard to find drillers. The assay labs are backed up. Multiple companies reported not just week delays, but month delays. It's taking 2 to 3 months to get assays on your drill core samples or any samples. And that's important. If you have a deposit and you're drilling it off to a higher degree of density to have higher confidence in it, you have to drill all those holes anyway. It doesn't matter if the assay lab's backed up. But if you're exploring and you hit something that looks like a quartz vein here, you need to know how much gold or silver is in it, and decide whether you want to drill more there or go on to the next target. If you got to wait 3 months to get those assays back, the year could be done before you decide, oh, we should have drilled more there instead of over here. So, growing pains, but it's a good thing in that it tells us something about the fundamental strength of the industry. And also, there's a fear going around once the blue wave took hold in Washington that the new administration would really put the kibosh on mining. And, it seems a little split personality there in Washington. In part, sure. The green agenda is very strong. On the other hand, they seem to understand that critical minerals are an issue. They seem to understand that you need uranium and rare earths to make a lot of the green agenda come true. And so there is a sort of oddly pro-mining part or fraction of the psyche in Washington now. So what I saw is that permits are still being issued. You file a notice of intent with the Bureau of Land Management, and you still get your 5 acres of disturbance. and so on. On some key issues like water and endangered species, I'm told that the local offices are much more hardcore, like they're really pushing hard on that. But those were issues anyway. That's not really new. It's not a change. So this is interesting for people who thought that Biden was going to stop all mining. That's clearly not the case. There is more red tape, and I think that would actually happen under Republicans or Democrats. It's always, the amount of red tape is always going to go up. But some interesting takeaways are, one, the Great Basin area that spreads out from Nevada into Idaho and surrounding states, business is booming. You see the company trucks, the support, the drillers, energy companies, they're all over the place. And the permitting regime is more complicated, but not impossible. So, people thinking, oh, well, don't invest in America anymore. I think that's an incorrect and hasty conclusion.
Again, for our viewers, some of the key ways to evaluate whether a mining company is worth investing in or not. Sure.
Well, that's a huge answer. There'll be a book I'll write someday on that, Elijah. But some quick tips would be, for any producer, look at the bottom line. Okay, there's COVID and there's other reasons why we might miss here and there. And certainly costs are going up. I don't hold rising costs against a company too much if they're not out of hand. But they should be able to deliver to the bottom line. If they have a mine worth mining at $1,800 gold, and not a spike to $1,800. It's averaged around $1,800 for the last year, Elijah. If you can't make money at $1,800 gold on a mine that was designed, by the way, at $1,300 or $1,400, anything that's built and in production now was designed a couple years ago, and most of those feasibility studies and models would have been $1,300, $1,400, $1,500 would have been aggressive. So if you've got a mine designed at $1,400 and can't make money at $1,800, that's a huge red flag. So very simple, look at the profitability. Now for projects, development projects and exploration projects, you don't have that bottom line to look at. But if there is an early stage study, a pre-feasibility study or a preliminary assessment, you can look at the assumptions there. And if they're assuming spot gold, and I have seen that, that's a red flag. If their project makes good money at a more now conservative estimate of 1,500, say, or 1,600 pushing it, still looks good. That's a project that can go forward. Honestly, it may or may not become a mine, but if you have a high margin at a conservative price, then that goes forward. Now, if you have no study, or maybe not even a deposit, just drill results, obviously you want to look at grade and thickness. So my takeaway there, sort of quick rule of thumb, is if you're looking bulk grades, bulk tonnage, big open pit bulk tonnage, you want 100 meters plus, you want ideally hundreds of meters of bulk grade for that to be exciting. 10 meters of a half a gram, it's something, but it's not going to be a mine. If you're talking high grade, it needs to be minimal mining width. And those machines, so you don't have guys, manual labor with jackleg drills in there, minimum is 1.5 meters. 2 meters plus is better for mechanical mining underground. So when you see drill results that are measured in centimeters, even if they're super high grade, you need to dilute those mentally. You need to discount that. And even if it's super bonanza grade, kilos of gold or silver per ton, not gold, but kilos of silver per ton, if it's over a few centimeters, and I've seen kilos over 5 centimeters reported, it's not just that you have to dilute that out to 2 meters of width. It's really difficult to build tonnage at a little 5 centimeter intercept. It's great, but you need volume to make a mine big enough to matter. So look for minimum mining width, minimum 150 centimeters or 1.5 meters. 2 meters makes me more confident that, yes, this is something that could be mined.
Fantastic. Well, Lobo, Tiggre, we really appreciate all your insights today. Before we let you go, if our viewers are looking for more of these insights from you, where can they find you, and any last thoughts you'd like to add? Sure.
Well, it's independentspeculator.com. We do have a lot of, I think, high quality educational material that's available for free. On this last topic, there's an article called What is High Grade? You can look up things like that. There's a lot of information there that can help you make more informed decisions, or even just digest company press releases. And if you want to sign up for our free weekly educational newsletter, I promise we won't spam you. That would be my main point. I'm trying to run an honest business here. I'm trying to be fully transparent with my track record and not hype people into making decisions they regret. So I welcome any and all to come and check it out. Thank you, Elijah.
Fantastic. Lobo, thank you once again for your time. If our viewers would like to hear more of these interviews with you and all of our other guests, go to libertyandfinance.com and sign up for our free newsletter, or hit the subscribe button on YouTube and the bell icon. Once again, Lobo, thank you so much for your time, and God bless. This week's specials with Miles Franklin Precious Metal Investments. 1 ounce 2021 Silver Britannias for only $3.75 over spot. And 1 ounce 2021 Silver Krugerrands for only $3.95 over spot. Call us at 1-888-81-LIBERTY. That's 1-888-815-4237.